Hi judges, my name is Alice Nguyen and this is Amando Guetta. We come from Gustavus Adolphus College. Today we want to issue a buy recommendation for Thrivent Company with a 1-year target price of $93.90, representing a 19% upside from the January 6, 2020 closing price of $79.61. Our recommendation based on 3 key reasons. Thrivent has a strong business model. The industry is in a development stage and they have secured a dominant position in the industry. First of all, I would like to give you a business overview of the company. Thrivent is a small cap company in the mechanized cleaning industry. Their focus is on scrubber and sweeper. Their global headquarters is in Minneapolis, Minnesota. Regardless of being a small cap, Thrivent is one of the largest manufacturer of cleaning equipment worldwide. They have over 4,300 full-time employees on 3 geographic regions of the America, EMEA, and APAC. They own 13 manufacturing plants and over 400 distributors across more than 100 countries. In 2018, they own 20% of the global market. About the corporate governance, Thrivent management team has a very diverse background and experience. Before joining Thrivent, they has worked in high management and executive position in small and large company. Like their CEO, Chris Killenstad, before joining Thrivent, he worked as a senior vice president for Pillsbury, and he has joined Thrivent since 2002 as a vice president, and soon after he moved up as a CEO of the company in 2005. The entire team is made of capable and experienced individuals who has the knowledge and managing style of large and successful companies. So we believe that they will lead Thrivent to be large and successful company in the future. Into the first reason why we think that investors should invest in Thrivent is because they have a very well-rounded business model that make customers keep coming back for more. From the first interaction with customer, Thrivent is already outstanding compared to competitor because they have a wide range of products, from expensive and high technology products for customer with a high requirement to middle tier and low tier product for customer with a tighter budget and a lower need. When the customer is set on the product, they will offer business solutions such as financing, renting, and leasing program, and so to help customer finance such an investment and also to secure a sale. During the user's time of the machine, they offer repair services, and when the machine gets old, they offer discount for returning client. They also buy back their own machine, therefore they control their own secondary market. Because of the well-rounded business model and a strong management team, Thrivent has been doing really well in the last few years. In the last 3 years, their revenue has been growing by 12% on average, and this strong growth base was because they have a strong organic sales in all 3 geographic regions, and also they have favorable pricing in the Americas and EMEA. In the main market, America, their sale has been growing by 21%. The sale in Europe has more than doubled, and the sale in Asia market has also increased by 11%. Overall, we believe that Thrivent has a very strong core business model.
The second reason why we initiated a buy recommendation for Thrivent is because the industry still has room to grow. We believe scrubbers and sweepers will continue growing because of new technologies, a stabilizing global economic outlook, and greater business adoption, especially in China. The company's experience in developing leading technologies gives them an edge in filling gaps of use in the industry. For example, Thrivent's iMop scrubber is a small machine that can be used to clean previously inaccessible spaces, like fast food dining areas that can only be cleaned with a mop and bucket to get around obstacles. Recent indicators in the US show signs of life. The ISM index is finally above 50 at 50.9% for January. This is especially a good sign considering the sector's weak performance over the last few quarters. And although global economic indicators are mixed, Thrivent's strong business model led them to be resistant during the last economic downturn. And also today's low unemployment rates drive undesirable routine positions like custodial jobs to either raise wages or improve the conditions. Scrubbers and sweepers streamline the cleaning experience, so they make these traditionally undesirable jobs more attractive and therefore more economical for clients. The Asia region's primary growth point is China, which Thrivent has targeted with the acquisition of Gaomei. China's economic growth and huge population means there's potentially a large there's a large customer base there. We believe China will drive the industry's growth rate in the future as the greatest source of business adoption. Until then, Tenet will continue to experience economic growth in its 3 major regions and with the industry.
Our third reason for a buy recommendation is because Tenet has secured a dominant position in a highly fragmented industry. Compared to competitor, Tenet has offered the highest quality of product. The increased spec per dollar offer greater value for customer. First mover advantage gives Tenet the momentum for continuous innovation or acquire breakthrough technology from smaller competitor. Right now, Tenet is way ahead of the industry in terms of size, technology, and brand recognition. Their size and with an effective management strategy will position Tenet with a continuous expansion both organically and with the industry. Neofis is Tenet's closest competitor. They offer a wide range of product and also compete with Tenet in all 3 geographic regions. However, recent financial statements show that they have been losing sales in this region because of a discontinuation of large customer contract and also a delivery problem. This weakening of the direct competitor offered Tenet an opportunity for acquired Europe's largest manufacturer of cleaning equipment. We believe that Tenet IPC will be a good competitor for Neofis in their main market, EMEA. Karcher and Hakos are also the 2 biggest competitors of Tenet. Even though they seem like they have an advantage because they only focus in the middle tier market, when we put their products side by side to Tenet, it was clear that Tenet product has a higher performance theoretically, and we believe that IPC will also be a good competitor with these 2 companies. Tasky is a small and private company that offers fewer products with limited quality. Tenet's size and technology will help this company outperform Tasky easily, and the same thing can be said for the other 38% of the market.
As for our evaluation model, we had a target price of $93.90, and that was based on a combination of intrinsic models and multiples valuation models. Our intrinsic models were the discounted dividend model and discounted cash flow model, while our multiples model were the PE and EV EBITDA peer analysis. Each method was weighted equally in our targeting price. When we look at the line graphs, we can see on the multiples ratios that Tenet moves consistently with their peers, and although they're above the industry, we don't believe the difference is high enough to cause concern. What is worth noting is that the EV EBITDA for Nilfisk is far below the Tenet and the industry's average. We're looking at a ratio that's about half a Tenet, which provides a cheap takeover opportunity for Tenet if they choose to go with that route. As for our investment risks, A1 refers to a high level of indebtedness. This may restrict Tenet's ability to make favorable acquisitions, but Tenet is still more liquid than their competitors, so we rated it low probability. A2 refers to the tariffs between the US and China. Before the phase 1 trade deal, the tariffs increased cost of goods sold by $10 million or only 1.5%. So even if tariffs are a given, the impact is mostly a non-factor. A3 refers to slow adoption by China. As we said earlier, China represents Tenet's greatest opportunity for growth. And although as the country moves away from mops and buckets to more sophisticated scrubbers and sweepers, the customer base will grow exponentially. And although we expect the swap to happen eventually, the speed depends on management efficiency and business trends. A4 refers to impaired goodwill. 18.4% of Tenet's assets are goodwill, so significant impairment would lead to a higher level of leverage. So in conclusion, we have a buy recommendation for Tenet with a target price of $93.90. This is driven by 3 key factors. Number 1, Tenet has a strong business model. Number 2, they are participating in a growing industry. And number 3, they have a dominant position in that industry. Thank you for your time, judges. We will now be opening the floor for questions.
So you mentioned that Tenet has first mover advantage, and I assume you were talking about in autonomous scrubbers. Is that correct? Can you talk about where their competitors are at with autonomous technology?
Right now we know that Tasky is also cooperating with BrainOS for the autonomous scrubber, but we actually compare Tenant scrubber with Tasky scrubber, and Tenant theoretical performance is way ahead of what Tasky is doing right now.
Yeah, so although BrainOS is the one who provides the software to make autonomous scrubbers, Tenants just has more experience and better quality scrubbers themselves. So when you look at mechanics, they have higher carrying capacity, they have a faster speed, and they're just superior when you compare their specifications side by side, even when you're looking at similar price points.
Okay, in your one slide, I think you talk about the Nelfisk is actually lower multiple valuation. There's a possibility for Tenant to take over Nelfisk. That's what you just presented. So what's the strategic rationale there for them to acquire Nelfisk? And also, I mean, set aside the regulatory barriers there, but what's the rationale there for them to acquire? What's the benefit of that acquisition? I mean, obviously they're the largest two players in the market, right?
Okay, so the benefit to acquiring Nelfisk is that, as we said, they are Europe's largest producer of scrubbers and sweepers, and they are also one of the few large companies that competes in multiple product tiers. So they're able to take that player out of the game, especially because they have been a big player for such a long time. This recent weakness in lowering sales by not being able to renew large customer contracts and having delivery issues just provides a unexpected weakness that's just, the management weakness just provides a great opportunity for Tenant to reduce competition.
What's the likelihood of a deal like that getting through regulatory hurdles?
Excuse me, can you repeat that question?
So what is the likelihood of a transaction like that getting through regulatory hurdles?
Well, we did talk to Tenant about the possibility of them acquiring Nelfisk. Is that your question? Oh.
Sorry. Okay, so what is the likelihood of them acquiring them, especially when you think about regulations?
So in jurisdictions in the United States and Europe and other jurisdictions, oftentimes when you have an M&A acquisition or M&A transaction, you're going to need regulatory approvals.
Yes.
And so my question to you is when you look at both Tenant and Nelfisk, what do you think the likelihood of them getting through the regulatory process and having that transaction approved by regulators?
Okay. So when you think about the U.S. perspective for that, monopolization laws, when you think about the Sherman antitrust laws, have seen a more, they've been more lenient. They kind of, they lean towards the Chicago school of thought where free market will lead to more fairness. So especially when you look at the history of antitrust laws, they used to be much more stringent, so that even if there's 5 competitors, that's too few. But nowadays, if you look at telecommunications, 2 competitors is now seen as enough. And so on the US perspective, we don't think that poses too much of an issue, especially because the industry itself is quite fragmented, with 38% of it being small companies. So there'd still be plenty of competition, and the same can be said for the European counterparts. Although Europe is more stringent than antitrust laws, the competition is still high enough, because the barriers to entries aren't there. Tenant's barriers to entries is because of the brand recognition. The brand recognition is something that's developed over time. As we look at the likelihood of a transaction happen, Tenant has not shown an interest in future acquisitions, as they've already made many of them recently, but they have indicated openness to making an acquisition if one of their major competitors was opened up for sale, and Nelfisk being the biggest one means that I expect the management team to have their eyes on them.
Thank you.
So I'm going to ask about valuation. Can you pull up that slide again? And I know you said you equally weighted the different types of valuation processes.
We should gotta figure out how to go backwards with the clicker.
This one doesn't do that.
Oh, there we go. Never mind.
There we go.
So
So can you walk me through some of the key points of your dividend discount model, first of all?
Okay, so we have a three-stage dividend discount model. We have a high growth period, a slow growth period, and a constant growth period. The high growth periods, it will be in the next 3 years, and we have a growth rate of 9%. This was according to the value line evaluation of tenant at the point we was doing our investigation. Our slow growth periods is the next 11 years after that, and it was 7.6% because we was based on their past performance, the average of their past performance. And the constant growth period, we rated as 3% because this is their organic growth rate. So we think that in the long term, that should be a good indicator for their growth rate when the industry has been slowed down, I guess.
Right. And is that equal to global GDP growth, or how did you settle on 3%?
Oh. Yeah, the organic growth rate based on the organic sale growth rate. So it's only account for the increase in the sales year by year. We don't account for the transaction like
So the organic revenue is going to be the increase in units without taking into consideration price increases or the impact that exchange rates may have. So our growth rate isn't really based on GDP, it's going to be based on the company's own ability to create value.
Okay, thank you. And then in the DCF, can you adjusted that for debt, and that's based on debt in 2023? Is that what that number is? Or is that current debt?
So the question about the net debt is that number we're getting from the debt they have, the amount that they're having right now at the moment.
Okay. And then on your EV to EBITDA multiple, I'm just trying to figure, have you looked at that on a historical basis, where they typically trade around competitors, or their own history versus S&P? How are you coming up with that method?
Yeah, we do use the historical performance, like strictly, yeah, the cash flow, like historical cash flow performance, and also the historical EV/EBITDA average has been doing, yeah.
Thank you. I'll pass it.
Has Tenet done a good job with capital allocation?
Has Tenet done a good job? What was the rest?
With capital allocation.
With capital allocation? So they have recently become more leveraged, and we did mention that that's a low probability risk because they're more liquid than their competitors. When you think about current ratio, quick ratio, the only indicator that shows some weakness is their times interest earned ratio. But before the acquisitions, they were around 50, while the industry average is about 14. So before the big acquisitions, they were way, way above that, and now they went down, but they're on track to make that times earned ratio back to normal.
What's the current EV multiple that the company's trading at now?
We don't know the answer to that question, I'm sorry.
That's okay. And then the other question I had for you is that I think you noted in the slide that the company has a high level of debt. How do you, or why do you consider it a high level of debt?
So the high level of debt isn't based on liquidity, but more based on their recent issues of bonds. So high is based on they're usually very cash heavy, very equity heavy, and very low in debt. So high just means that they've taken on debt to expand, to help fund their strategy shift of going overseas.
Thank you.
Thank you, judges.